I have the same 12 months and 365 days in a calendar year that you do. But for the last 25 years of my life, the way I've led my businesses through those 12 months and 365 days has been dramatically different from the way you've led yours. And my bet is that I'm more effective in goal attainment and financial performance than you've been. It's not attributed to the difference in my business versus yours. It's not attributed to my experience versus yours. And it's certainly not attributed to my work ethic versus yours. There is, however, a major difference in my year versus your year. How can the same measure of time be so different? If you assume it's all the same, then it's time to question one of your most fundamental assumptions. Welcome to the Next Level Executive Podcast, a show dedicated to dentists who want to evolve from a clinician who owns a practice into an executive who leads a business. I'm your host, Perrin Desports. If you own a practice that generates over $1 million in revenue and you're wondering what's next, you're in the right place. The most overlooked, easiest tool in leading for results isn't really even a tool at all. The straightforward answer is found in the way we break apart our 12-month, 4-quarter cycle by which we measure performance. You and I both work with accountants who report our income, make deductions, and calculate taxes on a calendar year basis. Because of that, you default to a start date for your new year to be January 1st, and you end your year on December 31st, which happens to be my birthday. And I've noticed a few of you are behind in sending cards and presents. But I digress. Because our accountants report our financial performance year on a calendar basis, and because the calendar runs on, a calendar basis, we all automatically default to planning our performance year against that same backdrop, January 1st to December 31st. That's fine, but your business, like most, have a high degree of seasonality or cyclicality to them. I'll give you an example and reference a recent episode where I had Dr. Paul Lund and his COO, Misty Wales, on the podcast. They run a pedo-ortho group in the greater Seattle area and are about as operationally tight of a group as any I've ever worked with. Nothing gets by them. But last year, I challenged an assumption that grounded their strategic planning process. I asked them to consider shifting the 12-month, 4-quarter cycle in which they track financial and operational performance. Let's just refer to it as a performance year for the sake of simplicity. Think about a pedo-ortho group for a second. How cyclical is it? I think we'd all say very, because their business is dependent upon the flow of children, and that flow is greater when the kids are out of school, right? Maybe that spring break in the, spring, and certainly the summer months between June, July, and August. Those summer months for them are definitely, hopefully, high water marks in terms of performance. They're also high stress months for the team because the business is probably running at 10/10, meaning wide open. They probably also experience a higher level of patient flows around that last 6 weeks of the calendar year due to kids being out of school for Thanksgiving and Christmas, as well as attributed parents trying to maximize insurance benefits before they roll over at the end of the calendar year. Once again, we're all busy as heck during those last 6 to 8 weeks of the calendar year due to the holidays, hosting family members, traveling, buying gifts, going to holiday parties, etc. By the time January 1st rolls around, we and our team are all probably completely worn out from all of it. I think the two keys to think about thus far are your highs and lows of overall patient flows, and how those patient flows, as well as the seasonality of the 12-month cycle, impact your team from a mental and a physical energy standpoint. I'll ask a question here. If you were about to start a marathon, would you want to be standing on the starting line feeling like your tank was empty and you had no energy or stamina left? Of course you wouldn't. So how do you feel on January 2nd when you reopen your business after a hectic end of calendar year from a rush of patients and from all the stresses of your personal life over the holidays? I'll answer that one. I'm totally smoked, spent, and need at least the first week of the new year to get things back to normal. My bet is you and your team do as well. Let's build on this for a minute because there is a lot more to it. If you're starting your performance year on January 1st, then when are you pulling the team together to lay out your strategic plan and involve them in building the executables for each initiative? Most planning occurs on the lead up to the launch, so it can still be timely. So my bet is that you're doing your planning sessions about 6 to 8 weeks ahead of the new year, which would probably be early November for most of you, which would also be right before the most hectic time of the year for most of you. If I'm being honest, I'm not sure that's ideal. Let's maybe talk about what I think is ideal. From a performance standpoint, we need to look at the peaks and valleys of the revenue cycle of our business. We all love the quarters when we crush it, but sometimes we hit really high highs, and that makes for daunting challenges in the subsequent year, right? It's tough to overcome record performance, and you'd hate to have a good year rolling only to have it be washed away when a good quarter fails to overcome a prior great quarter. For this reason, I'd ideally want my highest quarter to come in quarter 3 of the performance cycle. My reason being, I want another 90 days to make up for any shortcomings that I failed to achieve against my highest highs. If we eclipse those high highs in Q3, then we can coast in Q4. On the other hand, if we don't eclipse those high highs in Q3, then we still have 90 days to pour on the gas and make up for it in Q4. Part of being effective in leading performance is to learn how to manage cycles in your business and to use cyclicality to your advantage. If we go back to Paul and Misty in the pedo-ortho business, my guidance was to view June, July, and August as their high water mark and mark it as Q3, then use September, October, and November as Q4 and end their performance year at that point. I think they settled on May, June, and July as Q3, then Q4 being August, September, and October in an effort to stay clear of the holidays, which makes also perfect sense here. That Q4 period would also align nicely with a strategic planning session to kick off in late September when the team has refreshed from the end of summer and they're more creative. Then culminate for a rollout at the end of October for a start to the new performance year on or around November 1st. Here are a very few key leadership points to shift your mindset, and these are critically important. If your planning session takes place when your team is distracted or mentally fatigued, then you're not getting the most creativity or focus out of them. If your performance year starts when they're at a low point energy-wise, then you're not creating any momentum to start the race. If your performance year ends at your peak quarter to overcome, then you have no margin for error unless you have a huge lead going into that quarter. And here are 2 more points to remember. 1, I'm not telling you to have your accountant adjust the time period for which he or she reports your taxes. Let me repeat that. Do not change your tax reporting year. That being said, your CPA should be able to provide financial reporting based on any date range you specify and on any trailing 12-month period needed. Your practice management software and your dashboard KPI software like Dental Intelligence should be able to do the same. So simply change the defaults from the calendar year to the range you specify based on your performance year. You can run your performance year for any 12-month period you want. 2, I'm also not implying that a change in your performance year period will magically result in double-digit revenue outcomes when you were only in the low digits previously. There's no silver bullet here to your business or mine. You've still got to drive performance of the business, but it's simple adjustments like this that usually add a point or 2 of revenue gain due to change of focus and commitment. And a 2% gain on a $10 million revenue business is $200,000 in revenue. That's quite a bit more than a lucky win in my book. As a business grows, we as leaders have to figure out ways to generate small, incremental wins. Big chunks of revenue become harder to manufacture, so you have to look into any and all areas of the business for little wins here and there that add up to a lot when taken in the aggregate. Even though my business is smaller now, the lessons are the same on my end. One of the areas I'm most focused on right now isn't actually revenue, but ratings and reviews. By now, you've heard me say that my goal with the relaunch of the podcast is to get to 55-star reviews on Apple and 25-star reviews on Spotify. I'm at 43 on Apple and 16 on Spotify as of this recording. So if you value the content I'm sharing, please scroll down in the app on your phone and tap the 5-star button. If my thought leadership makes a difference for you, just know your rating makes a huge difference for me. Honestly, one of the things that keeps me going are the actual reviews themselves. Like when Dr. GUD said, Perrin does a great job in explaining things, stating facts as they are. No BS, just straight talk. Absolutely love the podcast. I make sure I listen to every episode as it comes. Thanks for helping dentists grow. I think that might be my buddy Praveen, but I'm not 100% sure. Regardless, thanks to Dr. GUD out there, Dr. Good. I'd love to hear from you as well, so leave a shout out if you think about it. So back to this shift in your mindset about changing the way you look at your performance year. I'm going to go out on a limb and assume that some of you readily embrace my guidance, but others are, for some reason, you're still skeptical. This is for the skeptics now. As I've referenced on numerous occasions, I started my career at Patterson and taking over the Richmond branch in late July of 2002. My head was spinning for a myriad of reasons, but one comment from the regional manager, Harry Herron, who hired me, was the following. Perrin, the timing of your entry will be good because it'll be the start of Q2. I was a brash, young 31-year-old and thought to myself, great, I'm working for a man who can't count because July is actually the start of Q3. I quickly learned that publicly traded companies set their own performance year, which they refer to as a fiscal year, and they do so as a reporting cadence for Wall Street. The company can pick any 12-month period they choose. So some choose calendar years, but most do not. For Patterson, that fiscal year didn't correspond to calendar quarters at all, in fact. Our year started on May 1st and ended on April 30th. Huh? Why would the leadership team choose that period? It makes no sense, does it? Well, let's see. I'll share some rough statistics for the company from my time there. I left the company in January of 2017, and up to that point, the dental distribution market was basically a third, and a third. Shine had about a third total market share, Patterson had about a third, and the remaining third was Benco and all of the other independent dealers. Pretty easy to follow so far. The interesting point between Shine and Patterson is that while they had roughly the same overall market share, the respective shares were not made up equally. Shine had a major government and institution business which accounted for a lot of their consumable sales volume, and Patterson didn't even play in that market segment at all. Patterson, on the other hand, sold about 50% of all equipment and technology in the dental market, with Shine and the other independents combining for the other 50% of the total. Patterson was actually a smaller company in terms of headcount and total revenue volume. So how was that equipment and technology statistic even possible? Want to know? Well, the answer starts with you. All of you run your accounting and tax year according to the calendar year, right? So every year, in a mad rush, your accountant comes to you in October or November, or even later sometimes, and says, "Hey, Dr. Smith, you've had a great year. You're going to pay a lot in taxes unless you can find some equipment to buy before December 31st so we can take the depreciation to offset your taxable income." Sound familiar? Trust me, it happened like clockwork. The leadership team at Patterson knew the company would get its share of those last-minute equipment and technology purchases, just like Shine, Benco, and all the other dealers would. But that November-December buying season would be a competitive one with a lot of noise. So it would be tough to take a lot more than your share of the market during that period. So, what did they do? The leadership team at Patterson decided to run the company's fiscal year through the end of April, thereby creating a second buying season in late March and April, where the company would run sales promotions alongside its manufacturer partners. All of the sales reps wanted to make their annual quota bonus, so they were incredibly focused on generating and closing deals. It was a mad dash of activity in an otherwise totally dead time of the calendar year, and it worked like magic. Yeah, our Q4 of the calendar year was always incredibly large due to all of you buying equipment and technology to end your year, but we were all waiting for the second wave to come a few months later, and that was almost as large as the one at the end of the calendar year. Did it work? I'd say a company with a third overall market share, but 50% share of the entire equipment and technology market would count as it being successful. And why was it successful? Because we were all focused on the April finish line, and we were fresh from a quiet period in the months of January and February. A simple challenge to a long-held assumption that produced a dramatic result. If you think it can't work or won't work for you, then you're the reason it won't. I've used this performance year leadership principle in every company since I left Patterson and know the merits of the application. Furthermore, I taught it at our CEO session last September and will do so again in the upcoming CEO working group session in Austin this August. If you're a listener to the podcast and still wondering what professional development and honing your leadership craft is all about, you're getting a taste of what it truly means to be an effective executive. Then again, maybe just being good is good enough for you. I think the 40 people I'll have in that room would say otherwise. In that upcoming CEO working group session, I'll spend some time walking through ways to be more effective in leading a strategic planning session. Planning is important, and there are specific methods to creating greater congruency and accountability to deliver the results you intend. I probably love that creative planning process every bit as much as you do. But it might shock you when I tell you that the last thing you need right now is a strategy. If you're wondering what's next for you and your business, the answer's waiting for you on the Next Level Executive Podcast.